Students, today's session I will be dealing with the last module in financial management. I will be taking the chapter capital structure, cost of capital and valuation. It is one of the modules which we had left. So in capital, starting with capital structure first, and the second portion, cost of capital, I will deal it in the next few videos. So in the capital structure, we have to study various theories under capital structure. Capital structure theories includes net income approach of David Durant, then net operating income approach of David Durant, and another one is Modigliani Miller approach or approach, and there is something called traditional approach. Okay, so these are the things which we have to go under capital structure theories. Capital structure, before getting into the capital structure theories, you have to know what is capital structure and why we are studying capital structure. Capital structure, the name itself, it is clear, the structure of the capital of the company. Okay, means what? Debt and equity. So debt and equity are the two combination which is used by any firms as capital. So that is capital structure, debt equity combination. Okay, so the debt equity combination, we cannot put it on our own decision. There are certain limiting factors which explains about how much debt a company should raise for capital and what should be the proportion of equity, and how it implies or how it relates with value of the company and overall cost of capital of the company. That is very important. By taking a mix of debt equity, a company should always track into whether the value of the company is also increasing by that capital structure. Okay, so that V is very important, value of the company. Similarly, the cost of capital, this term you had studied under capital budgeting, overall cost of capital. What is overall cost of capital? Minimum rate of return a firm must earn on its investment where the value of shares remain unchanged. That we had studied earlier under the capital budgeting. So keeping the overall cost of capital very less and increasing the value of the company is the final objective of determining the capital structure. Or we could say that optimum capital structure, optimum, that is maximum combination of debt to equity makes, maximum combination of debt to equity makes is what is called as optimum capital structure. So how do we define optimum capital structure? Optimum capital structure is the combination of debt equity mix which maximizes the value of the firm and minimizes the overall cost of capital. So how in a problem, when we come into the problem side of capital structure, using various models like net operating income approach, net income approach, approach, etc., what we are finding out there, we are finding out value of the company and cost of capital, overall cost of capital changes. So let us look into the first approach, net income approach. Net income approach of David. Here it is mentioned too because there is something called traditional approach. I am using here M.Y. Khan and Jain's textbook of financial management, leaving I.M. Pandey, which I had been used in the earlier videos. This I.M. Pandey's textbook also explains the same thing. But in M.Y. Khan, first method, it's not mentioned, they had gone directly to second method because first method they had explained it based on the traditional approach, which I will explain it in the incoming videos. Now look into what is net income approach. Net income approach, the net income approach had been suggested by Durand, D-U-R-A-N-D, Durant, or we could call him as David Durant, financial analyst, had propounded net income approach. What are the things which we will know under the capital structure problems, and what we find out? What we have to find out? We have to find out value of the company, V, and overall cost of capital, and the changes in the value of the company and overall cost of capital because of the changes in the leverage. What is leverage? Financial leverage means borrowing more and more debt capital. Okay. David Durant's net income approach. In a problem, they will give information like net operating income. Okay, informations you could see in this problem. Problem number 19.1 under MY Khan. This I will scan it and attach to you in the WhatsApp notes. Problem MY Khan 19.1 explains, or you could look into what are the things which had been given under the capital structure problem. A company's expected net operating income or earnings before interest and tax is given. So EBIT will be given in that problem. Company has a borrowed capital 2 lakh 10% debentures. So company's borrowed capital position will be given, and equity capitalization rate, okay, or K, cost of capital, will also be given. These are the three informations which will get, and they will ask you to find out the changes in the capital structure or the effect of value of the company and overall cost of capital because of the changes in the leverage. This will be the question. So how do we do? Let us look into this problem. The steps involved is that first we have to take the net operating income. So net operating, this approach is called as net income approach. Okay, net income approach. So from the net operating income given, we have to find out net income. What is net income? Net operating income or EBIT minus interest on debentures or interest on borrowed capital. Interest on borrowed, here it is debentures, borrowed capital. Here it is debentures, or we have taken debentures. Interest on debentures. What is the borrowed capital here? Company has 2 lakh 10% debentures, means 2 lakh is the borrowed capital. 10% interest, it will come 20,000. So 50,000 minus 20,000. What is this? Net operating income or EBIT. Both are same. We could use it as synonyms. Okay, synonym of net operating income is what? EBIT, earnings before interest and tax. So from EBIT, if we deduct the interest on borrowed capital, what we get? We get net income. Now what we have to do? What are the other informations given? K is given. Cost of equity capital is given. Now another important equation is that this obtained, the result net income divided by K. K is given in percentage. Divided by K is the market value of equity. So 30,000 net income divided by K 12.5%, we will get market value of equity. That we have to find out. Market value of debt is already given. What is it? The company has 2 lakh 10% debentures. So market value of equity we have to find out. Market value of debt we have, it's given. So total market value of equity plus market value of debt, we get the value of the company. So what we found out under the net income approach, based on the position of operating profit, earnings before interest and tax, we found out what is the market value of equity and market value of debt. Now next what we have to find out, I told in capital structure all problems we have to find out V and KO. Value we found out, S plus B. Market value of equity plus market value of debt is V, value of the company. Next we have to find out KO. Why we are finding these two things? Because the objective of optimum capital structure, determination of optimum capital structure is that the company's debt equity combination should be in such a way that value of the company should be very high and overall cost of capital should be very low. Now let us see how we find out overall cost of capital. Overall cost of capital equation is like this. The total value of the company we have to compare. The total value of the company is 4,40,000, and of which how much is the equity proportion? Equity proportion is 2,40,000. So 2,40,000 divided by 4,40,000 is the proportion of equity. What is its equity capitalization rate? Equity capitalization rate we got from the question 12.5%. So 2,40,000 divided by 4,40,000 into 0.125, that is 12.5%, plus that is equity proportion, plus debt proportion. Debt proportion is how much? It is given in the company. 2 lakh is the debt, market value of debt. 2 lakh divided by value of the company is how much? 4,40,000. So that is debt proportion. Into what is the percentage of interest for debt? Percentage for interest for debt is 10%. So into 0.1. So we will, by applying this equation, we will get KO, or overall cost of capital. Once more I will repeat. Overall cost of capital is, the equation is like this. This is something called traditional approach of finding out the cost of capital. How do you find out? Proportion of equity plus proportion of debt. Proportion of equity, how do you find out? Market value of equity divided by value of the company into equity capitalization rate plus market value of debt divided by value of the company into debt percentage, or percentage of interest on debt. We will get 11.36%. So this is what we found out under the net operating income, net income approach of David, not net operating income, net income approach of David Duran. So once more I will repeat what we will do. We will find from the what are the informations given. EBIT of the company will be given. The company's debt proportion will be given. Market value of debt along with its interest rate will be given. Equity capitalization will be given. What we have to find out? We have to find out V and KO in the capital structure problems. V is equal to what? V, how do we find out? We will find out V by using the equation S plus B. What is S plus B? Value of market value of equity plus market value of debt. How did we find out market value of equity? Net income divided by equity capitalization rate, we will get market value of equity. How did we find out market value of debt? It is given directly. So market value of equity plus market value of debt, we got value of the company. Then how did we find out KO, or overall cost of capital? Proportion of equity plus proportion of debt. Both we have to multiply it with the equity capitalization rate and interest, we get overall cost of capital. But we have to test the leverage position by using net income approach, that I will continue it in the next video. So this is what we have to find out under the net income approach. Next video will illustrate the same problem using the leverage changes. What is leverage changes? In the next problem, the same problem I will take, but we will change the proportion of debt. That is, instead of 2 lakh, we will test it in two ways. Increasing the leverage, that is 2 lakh debt we are increasing to 3 lakh, and next the incoming further video I will explain 2 lakh debentures or 2 lakh debt, we are decreasing it as 1 lakh, and find out the changes in the V and KO that you could see in the next video. Thank you.